The book divides up sort of economic history over the last 100 years into three periods. So first we have the Roaring Twenties and the Great Depression, which is a period of high growth and increasing inequality, followed by really low growth, high unemployment, and of course ending in World War II. And then what it calls the Golden Age epic, which goes from the mid 40s to the mid 70s. It was a period of pretty low unemployment, high productivity growth, and really low inequality. So this bottom graph here shows the income share going to the top 1%. And you can see that sort of from the mid 40s to the mid 70s, the share going to the top 1% in the United States was pretty low, between 6 and 7%. Whereas in the 1920s and right before the financial crisis, it was closer to 20%. Then we have a period of stagflation in the late 70s. So stagflation, remember, is high unemployment and high inflation, followed by what was known as the Great Moderation because the recessions were pretty shallow. The unemployment rate overall was pretty low. Productivity growth was kind of in the middle. And a lot of macroeconomists were patting themselves on the back that, hey, we've kind of figured out how to deal with recessions. And then, of course, it was followed by the Great Recession, the global financial crisis, which was the worst recession since the Great Depression. So that turned out not to be so true. If we look at sort of profits and the growth of the capital stock, along with the effective tax rate here on corporations, we can see that during the golden age, we had both a high profit rate and a fairly high tax rate, and so that the post-tax profit rate, this green line in the middle, was pretty constant here. This is for U.S. non-financial corporations. One thing to note, though, is that the capital stock grew a little bit faster during the golden age than it did in the Great Moderation up to the financial crisis. And a growth in the capital stock is important because it is both, contributes directly to GDP in the form of investment, but it also allows for future growth. And so if firms are adopting the newest technology, investing in the newest types of capital, that's going to contribute to growth both today and tomorrow. One of the important changes after the Golden Age epoch, so in the sort of mid 70s, was the growth of debt. So you can see this is for the United States, and it looks at household debt, financial firm debt, non-financial firm debt, and the government. And you can see that both financial firms and households especially increased their debt levels pretty substantially leading up to the financial crisis. And this was definitely one of the causes of the financial crisis, was that especially households took on a lot of mortgage debt. And when the housing boom turned into a bust and the asset bubble popped, we ended up with people who couldn't pay their mortgages. And those were on the balance sheets of banks, and so banks got in trouble as well. The government didn't really increase its debt until after the financial crisis, when debt increased due to budget deficits, right, because of fiscal policy. So if we break down the last 100 years into sort of different periods, the 1920s, they're called the Roaring Twenties for a reason. They had low unemployment, they had high productivity growth. We had sort of the next period of the Industrial Revolution, and we also had rising inequality, right? So this was a time where the robber barons, the captains of industry were still active. That all fell apart in 1929 with the crash of the stock market and the coming of the Great Depression. We had high unemployment, we had a lot of deflation, and we had falling inequality. And then after World War II, we had what's been called the Golden Age, mostly because of the low unemployment and the high productivity growth. But another big piece of that is that we had falling inequality. we had actually really high tax rates um, on individuals, but falling effective tax rates on corporate profits. Then we had a period of stagflation where we had high unemployment and inflation. A lot of that was due to oil shocks, but it was also due to sort of questionable fiscal policy and a wage price spiral. And then we had the Great Moderation in the 1980s, where we had low unemployment and inflation, but we had inequality that was increasing and debts that were going up. And then that was followed by the financial crisis from 2008 to 2013. So if we look at these periods sort of across countries, the Great Depression in the United States was maybe worse in the United States than in a lot of countries, although it affected, most developed countries. Um, the UK, though, they avoided a banking crisis. They only experienced a modest fall in GDP. They didn't have the same sort of stock market crash that the US had. In the golden age, of course, the US came out of World War II looking really good because they had won World War II, Europe had been destroyed, Japan had been destroyed, and so the US was the technology leader. Outside of the US, it took them a while to invest to catch up, but they did start to catch up in the 1950s and 60s. And then in the financial crisis, it was really a housing bubble that created the banking crisis for the US. Other countries experienced banking crises too. Spain had a housing bubble of its own, but countries that were able to avoid a housing bubble experienced a much better situation. So countries like Germany, Japan, Canada. Interestingly, Texas actually experienced a much more mild housing bubble than the rest of the country due to laws that it had put in place during a previous bubble, and their experience during the Great Recession was better than most states. International openness was increasingly important for other countries. The US is so large that imports and exports are not as big a piece of the economy as they are for other countries. But they were important for places like Europe, places like Japan.